Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
That it is back to the old mindset around which side would you rather be on when it comes to a military conflict?
Well, I think it's a bit more complicated than that in that the U.S. is an oil exporting country, or at least marginally oil exporting. It's certainly become it's no longer dependent on oil imports. That has changed a lot since the 1970s when the U.S. really had a very difficult period of time because of OPEC and the kind of oil shortages that were experienced by the global economy. So I think there's some of that. I think there's this negative halo around Europe because it's viewed as oil importing, and so it has some disadvantages. The reality, though, is that when oil prices go up, they go up everywhere. And so unless there's actual shortages, there's likely to be less of a differentiation or huge issues in the U.S. versus Europe. But I do believe markets make sort of snap decisions. The quote from Benjamin Graham about markets in the short term being a voting machine and in the longer term being a weighing machine always sticks with me when I look at market reactions like this.
Well, I think we were looking at a really very interesting additional market reactions because there's been a spate of news flow. Just on the one hand, you mentioned seeing this kind of knee-jerk reactions markets are displaying. And we know that the chip market, I've showed many slides in the past around how the semiconductor index, how much that has increased. We've seen that now played out on a smaller stage in terms of the movement in Samsung. I think that has gone. I think quintupling is the phrase that I've seen in terms of it moving to a record high. That is very much on the back of the same sentiment that has pushed NASDAQ and the S&P to fresh highs. And on the same token, we have meme-like behavior when it comes to areas like GameStop offering to buy eBay at a valuation that is many multiples of its own valuation. I put up just a reminder for 2021, just to remind us perhaps how GameStop got this $9 billion of cash on its balance sheet and how it too was once a meme stock. And we've seen discussions around OpenAI and Anthropic in ventures to buy service firms and consulting outfits. So that's been another large ticket item out there around AI. So quite a lot of news flow and exuberant buying, I'd say, going on in the current market. How do you make sense of this and where investors are? Are they buying first, asking questions later? Or do they know something we don't?
Well, I just think that markets go through periods of different psychological moods. Before the Middle East conflict began, what we saw was a whodunit playing out, a reverse whodunit, where there was a lot of concern that AI was going to ruin different industries and sectors. And so we knew that the killer was AI. We didn't know who the victims were. And we were playing this guessing game where on a given day, you'd see software stocks sell off, for example. And so there was, less euphoria in markets. And then for the first month of the war in the Middle East, what we saw was, in general, no matter what stock market it was, going down. And then at the end of March, something changed, and we started to see almost a euphoria set in. I would argue that at least some of it has to do with earnings season and attention turning to what happened in the first quarter and all the positives, especially around AI. But we're really just going through different psychological market moods, and we'll see how long this lasts. Again, I think it will last until we start to see some downward earnings revisions.
And I think it is important to put this into a broader context. This is the last slide, and it's a little bit around anxiety therapy, because some of these issues like the dwindling consumer sentiment, the persistent inflation, the K-shaped economy, these are not new issues. They've been around for some time, and there's been an anxiety, I think, at play, as well as this desire of FOMO, not to be out of equity markets because it's perceived that bonds have been quite less valued. So there's a desire not to be out of the action and missing, which is a sense of anxiety. This, of course, has been, I suppose, been beneficial for traders because they've been able to, as one headline suggests, spinning the anxiety into gold, because it has led to more trading. We've seen Bitcoin, seeing flows turn positive again. So again, more risk on perhaps in that sense. And on the other hand, as I mentioned, bonds looking less attractive. We have the ongoing, I suppose, slow burn of this private credit question mark in terms of the redemption pressure, a suggestion now that some of the markups don't make sense in some of the retail evergreen funds, and that there's lack understanding. So quite a bit of therapy if investors are on the couch here, there might be quite a bit to contend with. How do you see some of these last these question marks maybe manifesting in markets? Will it mean that investors want to kind of crowd in to, as you mentioned, the technology safety trade, or are they willing to spread their wings a little?
Well, I think it will result in some crowding for at least a period of time. But in my opinion, market psychology is like the weather in Dallas. And you don't have to get sick of it, because before long it will change. And so I would anticipate that we will see, continued rotations. There will be something that investors are very excited about, and there will emerge risks that make them run from particular industries or sectors or assets. At the end of the day, though, I think it's so important, if one has a long-term time horizon, to just remain very well diversified, not get spooked. To a certain extent, you have to have blinders on. You have to know what's going on, but not let it affect your decisions, because markets are so unpredictable, and we just don't know how investors will react. We don't know how markets will move on a given day.